and welcome to the New Property Show. I'm Steve McMenamin. On this show,
Goro's back to explain specialist disability accommodation. Our panel discusses more buyers versus sellers part 1. But first, Rory will talk to Dane on financial planning and identify the risks.
Dane, welcome to the New Property Show.
Thanks for having me, Rory.
Thanks for joining us, mate. So you're a financial planner. Love to hear a bit more about what you do.
Sure. So co-founder of Own Financial Planning in Forces with Your Good Self, and been in the industry for around 20 years now, hence the grey hair. So started in funds management and sort of migrated towards financial planning, and now focus on sort of building wealth through property as the core of our financial planning strategies.
Fantastic. So I think there's some misconceptions about financial planning, and some people don't quite know what makes up a financial planner or what your full sort of remit is to a client. Can you step us through what are some of the key things that you might deliver for a client?
Sure. So I guess the buzzword that's used for sort of our financial planning approach is goals-based financial planning.
Sure.
So in the name, our whole focus for our clients is to help them achieve their goals, and they could be lifestyle goals, living a comfortable retirement. It could, and doing so not necessarily at the sacrifice of the present lifestyle. So
Sure.
really centred around building wealth through property at its core, but also looking after their superannuation, making sure they're properly protected along the way through insurances, and right through to making sure that there's some legacy conversations that you, through estate planning, that you're leaving something for the next generation.
Excellent. Are you finding that's more and more popular? Do you find that people really find that legacy piece very important when they're creating a plan?
Yeah, very much so, and there's a lot of interesting ways in which you can go about that. A lot of tax-effective strategies that help transfer that wealth in a way that doesn't necessarily give it all back to the government.
Sure, that's what we like, absolutely. So when we think about a property purchase, I tend to see it in kind of, there's 3 sort of steps, and we like to say, well, can you do it? Does the maths work out? Should you do it? And that's absolutely where you come in, and that's about looking at cash flows and whatnot, and then how to do it. And that's a whole other raft of decisions you need to make and people you need to engage. So love to get your thoughts really on maybe if we work backwards from there and say, when someone's looking at a property transaction, who should they be involving and for what purpose? Yeah,
sure. So I'll start, I guess, with the last part of that question, for what purpose. I think that's the most important bit, which is, start with the end in mind. What is the goal that you're trying to achieve, not just from buying this property, but the portfolio of properties you want to build over time. The most common one being essentially building a passive income portfolio that will create, in the future, a work optional lifestyle. So if you bring that back to the present, the starting point to be able to embark on that journey is, do you have the cash flow to be able to support that purchase? Not only do you have enough savings for the deposit, but also do you have the cash flow to be able to support any shortfall in the income that you're receiving for that property on the way, to keep you in the game. And then the second part of your question, which is who should you work with, essentially it's very important to have a good property strategist that's going to find you the right property, know the areas to buy that suits your budget. A mortgage broker is going to help you, with the myriad of different loan products that are out there to choose the right loan product and loan structure for your needs.
Sure.
Where we come in as financial planners, and one other obviously important professional is to have a good accountant that's going to make sure your structures are right and that your taxes, you're paying as minimal tax legally as possible. Where a financial planner typically comes in is often coordinating all of those professionals together around that client's overarching strategy. Great. So if the property purchase is the transaction that's being worked on, the starting point that we will work with them on is just understanding their budget. What are their cash flows? Do they have surplus cash flow to be able to support this? Then do they have sufficient deposit to buy the property that suits their goal?
Sure.
Then we'll bring in the mortgage broker, we'll bring in the property strategist, we'll bring in the accountant. Great. And work together to optimise that transaction.
Sure. So a massive area of interest and what people, I suppose, toss up is, do I look for a high growth property? Do I look for something that's going to give me return? Do I look at positive or negative gearing? What do you say to people when they ask you those questions?
I'll tackle the positive negative gearing part first. Really, it's not so much one property is positively geared, another property is negatively geared. Effectively, that is just an outcome based on how much you've borrowed and the interest costs associated with that.
Sure.
So the same property might be positively geared for one investor that just buys it outright. It might be negatively geared for another who's maxed out the leverage on that purchase. So again, it comes down to the objective that the client's trying to achieve and the budget that they have to be able to make that next purchase.
Sure.
From there, it just becomes a logical decision as to what you go out to look for in the market.
Sure. And so many things affect or impact the market and the different markets around the country. And there's, people often talk about different cycles going through the market. And I know this is absolutely an area of interest of yours. So when people are trying to pick the right market, the right location to buy, what sort of conversations are you having around that?
Sure. And I guess the first part of that is to ignore the noise. I like the saying, if it's in the news, it's in the price.
Sure.
So if the news is negative, you can probably be optimistic and vice versa if things are positive. So that's the starting point. In terms of the cycles, the key to understand that is they do play out over a long period of time. We're talking years, if not decades. And if we look at Australia and all the major capital cities, they're all having growth phases at different times in the cycle. So that's the first part to identify. If you look at over sort of 20, 30 years of data or more, all the capital cities have similar long-term growth rates.
Right.
They just grow at different times. So identifying those capital cities that may have been through a bit of a lull for a period of time that have the capacity to be able to grow relative to the other cities is a good starting point.
Okay. And where are you finding they are now? Where are you finding those opportunities for your clients? You're finding where are your clients buying at the moment?
Yeah, sure. So, I mean, in recent times, we've been focused on sort of southeast Queensland, Adelaide, and have started to sort of look at Perth as a growth market. Melbourne, in terms of investment, in terms of a city as an investment potential, it's the steadiest over the long term. Okay. So often a really good place to start because it's going to do okay over the long run. But some of these other capital cities, particularly Perth, that's been flat for a long period of time, has the potential for excess capital growth in the next 5 to 10 years. We think.
But it is definitely a long game, and I know that's your absolute view. So someone's got their property portfolio, or they're growing their property portfolio, buying the right properties, but then what else should they be thinking about in their financial well-being?
Yeah, sure. And I guess it's identifying the risks is a good one because it is a long game, and to get the best out of a long-term property portfolio strategy is making sure you stay in the game.
Sure.
So what are the main risks? For those who are building wealth, your biggest asset isn't necessarily your primary residence, isn't necessarily your property portfolio, it's your future capacity to earn income. So it's your salary income or business income that is the vehicle that finances all of these purchases. So that is the most important thing to protect. So we do that through income protection, life insurance, etc. And then the other risk is really what we've experienced in the last 12 to 18 months with rising interest rates. So it's making sure that before you even make that first purchase, that you've got sufficient cash buffers, that after settlement you've got money in the bank, that if something was to go wrong or interest rates were to go up or you're going to lose your job temporarily, you've got that buffer in place. That plus your saving, that surplus cash flow is going towards supporting your property portfolio over time too.
Great. One last question. A fair bit more noise around buying inside of super or outside of super, having your own self-managed super fund. Any thoughts on that?
Yeah, it's a really interesting space because I would say a few years ago, if you asked me, should you buy property in super, I would say run 1,000 miles.
Sure.
I really didn't like it as a strategy, very convoluted, expensive and limited loan availability. But I'd say in recent times, that's really opened up. It's become a very legitimate strategy. And often what we're finding is because of where interest rates are at the moment, a lot of investors outside of super are kind of tapped out for the time being in terms of being able to make their next investment.
Sure.
So we are looking in a lot of situations as what you can do in super to be able to acquire an asset base quicker than you would just investing unencumbered.
Great. Dane, thank you so much for your insights. I really appreciate you coming on the New Property Show.
Pleasure. Thanks for having me.
Thank you.
Goro, welcome back to the New Property Show. 10 properties, 10 years, almost 10 appearances for you.
That's right. Thanks for inviting me back, Steve. It's always a pleasure.
Fantastic. So today we're going to discuss SDA. What does that even stand for?
So a lot of people out there have heard about the hype around NDIS housing. That's probably the incorrect term. The correct term is specialist disability accommodation. So it's not everyone on the NDIS that is eligible for housing, otherwise there'd be 500,000 plus people in Australia. It's only the top 6% of disabilities who have specialist needs that the government pays for accommodation once they find a house.
So this is the high end, so NDIS being, I guess, the entry level. So you'd normally go, residential housing, we go the co-living, we go NDIS, is SDA as high as it goes?
No, there's no such thing as just pure NDIS housing.
Oh, okay.
Yep.
Yeah.
In fact, there was in the old system what they call SRSs, which has been in the news, supported residential facilities. They've been in the news over the last little while because effectively what they used to do was kidnap residents from places, right? I'm not even kidding, Google this. It's crazy the amount of unethical stuff that happened previously. So the government decided to scrap all the old ways, and they're still transitioning, and only pay for accommodation for the top 6% of disabilities. That's where the higher cash flow comes in if you can find someone to reside in a custom-built home for that purpose.
Okay, so these SDA homes for the top 6% of disabilities, there's obviously a lot of perks and a lot of people here, thousands of dollars per week rental income, a lot of people trying to sell them. But how do you get this right? Obviously it sounds too good to be true, but I don't think this would want to be my first investment because it sounds like high return, high risk.
Yes, and you're actually not far off the mark there, Steve. So it is a higher risk, higher reward product. Without playing financial planner on TV, I genuinely don't encourage people for their first investment property to purchase as an NDIS property because there is higher risk involved, especially if you're just buying from a sales agent. One of the key things is it's got to be married up with where the tenancy demand is. So if we're looking at pure data, and data drives this entire property market, right? And so the reason why we can rent out normal property is because the data says we have enough residents for a normal property. Similarly, for a specialist disability accommodation property, if we look at Victoria data, for example, Victoria data, there's only 6,900 residents across all of Victoria who have got access to the funding. And out of that, only 30% of them are currently looking for new accommodation out of 4 different categories. So it's a very niche market. There isn't space for, thousands of properties to be built every year. It's maybe hundreds of properties to be built every year altogether.
Well, it sounds like a tough gig. At the end of the day, a wide net. It'd be probably easier for you to just sell residential housing for the many.
Yes.
And you're dealing with the 1%.
Yes.
Why do you like SDA?
Because I've been in the, residential sales game for quite a while, and I decided after I declined an invitation with Richard Branson on his island, it was a long story for probably a few years, to focus all of my efforts on disability and social housing. And it wasn't easy, and part of it was doing it ourselves first because I believe leaders go first. So we raised $10 million worth of friends and family capital, literally built the plane while it was flying, right? And we were the very first people to ever build the NDIS for specialist disability accommodation as a privately owned provider.
Amazing.
Yeah.
Now, I've caught up with you a few times at some galas and dinners, and you said you've got some new products coming out. What's new in the property market that's coming out?
I love that. And so we're innovating beyond just, selling house and land style products. Two things that's happening in our space. So a lot of NDIS builds that we can do for specialist disability accommodation in Victoria. If there's someone that's got a land that wants to subdivide, there is town planning exemptions available if you work with a reputable provider like ourselves. So, for example, if you're splitting a block into two, building them as NDIS, we can get town planning exemptions relatively easily. So that's a huge win for people that are, say, in the eastern suburbs where there's a massive undersupply of NDIS housing. By the way, those that are looking to invest in Werribee in the west probably don't look at those areas for that particular purpose. Now, the second product we're about to launch is actually basically a fund where people can co-invest in properties using the superannuation and the like in 100K chunks effectively.
So bricks and mortars business.
Yes.
With literally brick by brick, pardon the pun.
Yes.
With $100,000 investments.
Yes.
So I think the advantage is there too is they've got a bit of protection because they're going in with, a syndicate or a group of people. Have you successfully launched that yet, or is that something that's underway?
We're at pre-launch stage, so we're taking an expression of interest right now. We intend to actually do the launch in a month's time. We're doing really cool things like 8% guaranteed yield. Even though I don't like the word guarantees, this is comparing to other funds. So we're competing in that space with a 15 to 25% maturity buyout in 3 years.
We did talk about this prior to here, and you've thrown yourself in the deep water.
Yes.
The word rental guarantees.
Oh, yes.
I know. So before we wrap up, rental guarantees, thoughts on them?
Right. So rental guarantees, first I'll talk about my thoughts on rental guarantees, then I'll talk about them in the SDA space.
Excellent.
So in general, rental guarantees, someone's always paying, right? It could be the landlord or the management agent who's tacked on a little bit more. There's always someone paying for a guarantee, and it's notorious in the apartment market especially, where I've seen these 7 or 8% guaranteed yields, and I know that the apartments have been overpriced by 50, 100,000, even more in some cases. Now, that might ruffle a few feathers, but the other thing is, in the NDI space, I'm seeing people offer guarantees. And more of these people that are offering guarantees are just sales agents. The key in the NDI space is not to deal with a sales agent, to deal with a provider.
Excellent.
Right? Now, if a provider's offering too many guarantees and doesn't have enough residents, then there's a high chance that provider's going to go sideways. And I've seen the top providers of guarantees in this space already go into liquidation or change their names and phoenix themselves out of a guarantee.
Sounds a little bit pyramid scheme. It seems like you're literally you're getting on another client to get the guarantee to pay for that.
Yes.
Okay, so rental guarantees, and I like your advice there, is, and even though I said I do some marketing myself, going directly to the source.
Yes.
I think particularly in any investment, obviously having the right team, but it's so important to go to somebody that practice what they preach. And why I keep getting you back on these episodes is that you're always innovating. You're the forefront. And I know that you don't do anything or recommend anything without testing yourself. So I think it's also known as ethical sales.
Yes.
So I want to thank you today for being on the New Property Show. Can't wait, and congratulations on your new launch. And would love to hear more about that business and how that's progressing when you come back again.
Thanks, Steve.
Hi guys, welcome to the New Property Show. This week's debate is buyers versus sellers, and what are you seeing more of? Who's going to open up?
Oh, certainly more buyers, without question. There's a shortage of supply, and that would dictate that there are more buyers than sellers.
Yeah, I've got to agree with that. There's definitely a shortage of supply. We're seeing it in all parts of the market. I tend to look at the weekly auction figures as well, and volume is definitely down, and clearance rates are still up there. So definitely people buying and not enough stock.
How about yourself?
Well, I definitely find, especially in the last 3 months, since interest rate has not increased, so many contracts have come in. So people who have held up for the last 12 months, they're signing contracts, they're making offers, they're attending auctions right now. So I think definitely more buyers at the moment.
Yeah, I'd agree with the panel. I guess sales activity started to rise around sort of October last year, and it looked like that was a natural floor, not dissimilar to when the share market bottomed as well. So property's moving in a similar direction. Obviously, there's differences city to city. There's 15,000 suburbs, so there's a lot of different things going on. But in general, yeah, definitely agree.
I guess I'm really surprised though that these guys are still getting loans, but you were saying earlier off camera about all these pre-approvals you had banked up. How does that, I guess as a broker, how does that work for you?
Yeah, so naturally, if you compare to, let's say, more than 24 months ago, interest rate has gone up massively. So the same people who used to be able to afford, let's say, $1 million or $800,000 of a home loan, now can only afford a $600K to $800K. So pretty much a 10% reduction in their borrowing capacity. But what you see is that they see a massive underlying needs for the, for a property in the younger generation. So there are a lot of support from families, and I think Dane will talk about that as well. When parents can give the children just some help to get them the deposit, and the government incentives allow them to borrow up to 95%. And even though interest rate has gone up massively, if you have a young couple with even average earnings, they still can afford to achieve their first home with these small deposit schemes that's going on. So I think it's more so market sentiment that the stop in interest rate increases have given them a lot more confidence in committing to these purchases.
Because Dane, are you seeing a lot more clients coming in for financial planning at the moment and actually sitting down and they're not even talking investment, but they just really want to get started?
Yep.
I guess my question is the younger generation getting smarter or lazier?
No, I don't think it's. I don't think it's one or the other. I think when if you're proactively seeking financial advice, I think you tend to lean towards being goal oriented. So we tend to get the less lazy of the cohort, I guess. And to Kien's point, it is harder to get loans, and if anything, the hardest thing is to build that first deposit. So that's what we're doing a lot of at the moment is around family guarantor loans, where the parents, they'll guarantor the deposit, so they're not taking the risk of the entire loan. The adult children can service the loan, but it removes that barrier of the deposit gap getting in the way of them being able to get a property.
If you do it the typical way, and you really were just starting from the bottom, it could be almost a 10 to 13 year journey if you're, on a 80 grand a year and you're trying to put a little bit away, and obviously the properties get further and further away. So real cash though, what could you do or deal with? If someone's bought a property for 600 grand, they've got the servicing power. Obviously going to need a deposit typically to hold a property. How's a real estate agent going to work in with you there? So what's the real cash that's going to need to come out of their pocket?
I'd allow at the absolute minimum. It's rough rule of thumb. Your 5% sort of stamp duty, your legals, etc. Buyer's advocacy costs if you're engaging a buyer's advocate to buy the properties are roughly 5% or a little bit more. 5 to 6% of the purchase is the minimum that you should have in cash savings. The rest can be guarantored, obviously, if you're in that fortunate situation where your parents have got equity and be able to help you.
So ideally, somewhere between that 30 to 35,000, if it was a 600,000
for that sort of property,
which is fairly affordable because you can almost borrow that money again too if you can. But I think it's fair on mum and dad if you take care of at least the fees.
I think that's a really good point around being fair on mum and dad, is being able to prove to yourself, not only to your parents, that you are a good saver, and that if you've got that habit in place, that will set you on a very good path for the next 10, 20 years of your property investment journey.
May I just ask a little point on that? It's actually a bank's requirement that you need to demonstrate you have genuine savings and an ability to save that 5%. So you either show that you have had that 5% in your account, or you have been paying, for example, rent regularly in place of showing that full 5%. So there are ways to demonstrate that you have the ability to commit to, it's a serious commitment, let's talk about it, right? You either pay rent or you pay a mortgage. And it's usually $500,000 of a commitment that you are getting yourself into.
What about these 100% loans? Do they not exist anymore? Or
For exceptional circumstances, so if you don't have savings, you need to demonstrate that you have very strong income and there are circumstances around it. So for example, if you are a very young professional, just starting out and put all of your money in paying off, say, your student loans, or reduce it as much as you can, but you are an accountant, a lawyer, or medical professionals. Usually serviceability in terms of income versus loan is not an issue. It's just like, if you want to get into property now, instead of having 5%, we can demonstrate, like I said, a pattern of, have you been paying rent? Have you been putting money somewhere else? But savings, paying off your HECS debt, put into shares, crypto, some other investments. So in a way, you just need to give the lenders or the banks comfort that you have the ability to demonstrate that.
So you need to be outstanding in one point of your life.
To make up for the other weakness in your borrower's profile, essentially.
And are you guys seeing mums and dads or other investors come in, I guess, on that point? So let's say that you're kind of getting maxed out. Are you seeing people teaming up? Or is there any other strategies to buy property, such as creating company under ABN? Do you have to always buy in your own name, or is there another way to do it?
If you talk about what I have seen, yes, it's actually a really good point. I see people joining together, teaming up, creating trust, creating, usually it's a unit trust. That's the structure that the accountant selected for them. Pull up the deposit and then go and jointly borrow. In many circumstances, doing this thing would allow them to access, obviously, the capital on their own. They may not have enough. On their own, they may not be able to borrow, as much. And now they could. And especially, there's a recent change with the government's guarantee scheme as well. I do want to mention that quickly. It used to be the case where you have to have a spousal relationship with someone as a first home buyers to access this support from the government. Now, two friends can jointly purchase together. So they're making it easier, and they still have to be first home buyers. They still have to meet the other criteria, being an Australian, at least a permanent resident or citizen, have good credit history, but now you can join together and commit to purchasing an asset.
Well, I think that's a sensible change, because I did hear about a lot of people getting into relationships that may or may not have been true to get servicing through. What about yourself, Dave? So obviously working as a buyer's agent and also on the vendor side as well, how do you go finding stock? Like, how are you, I guess, increasing your ability to get a slice of that action now?
Well, one of the things that I do as a buyer's advocate is, once I understand my client's desires or goals or their requirements, we look at the market. We look at what's on the market. We then look at what's on off market. So it might be listed with an agent that haven't got it on realestate.com or domain.com yet. And the other thing I'll do is go and door knock. If I see that there's no stock around that we can access that's available for sale, I'll go and find something. I'll look at properties through a number of different means, but I'll find something that will suit their needs. I'll go and knock on the door and see if the vendor is happy to look at selling.
It's almost like the job of an agent, really. But it seems similar. Yeah,
it is kind of like that, but it's really about the property for my clients and having opening that conversation with the vendor to see if they're happy to sell.
So what I'm hearing there is basically you just get the job done.
Correct, yeah.
That's all for this week. Thank you for joining us. If you want to see the full interviews, check out our website, thenewpropertyshow.tv. We will see you again next week.